Welcome to Money Matters. In today's video, we're going to be talking about debt payoff strategies. Whether it's credit card debt or student loans, debt can be overwhelming and it's important to have a plan to pay it off. So, if you're ready to learn how to get out of debt, keep watching. Also, don't forget to hit the subscribe button and turn on bell notifications so you never miss a video. Let's get started. The first strategy we're going to talk about is the snowball method. The snowball method is a way to pay off debt by starting with the smallest debt first, and then moving on to the next largest debt. By focusing on one debt at a time, you can quickly make progress and build momentum. For example, let's say you have 4 credit cards with balances of $1,000, $2,000, $3,000 and $4,000. You would start by paying off the card with the $1,000 balance first, while making the minimum payments on the other cards. This will allow you to see small wins fast. It can be very motivating when you see the balance of one of your cards become zero. Let's say you pay $100 per month on the $1,000 balance credit card. After 10 months that debt will be eliminated. Then, you'll take the $100 you were paying on the first card, and add it to the $200 minimum payment you were making on the second card. Now you will be paying $300 on the second card. It will be eliminated faster. Once the $1,000 and $2,000 balances are paid off, you would focus on the card with the $3,000 balance and so on. The advantage of this method is that it allows you to quickly see progress and can be very motivating. However, it doesn't take into account the interest rates, which means that you might end up paying more in interest over time. So, if you have high interest rate cards you would like to pay off faster, it might be more beneficial to use the avalanche method. The next strategy is called the avalanche method. This method involves paying off the debt with the highest interest rate first, while making minimum payments on the rest. This can save you more money in the long run as you will pay less in interest charges. For example, let's say you have 4 credit cards with balances of $3,000 each, but this time the interest rates are 15%, 20%, 25% and 30%. In this case, you would start by paying off the card with the 30% interest rate first, while making the minimum payments on the other cards. The advantage of this method is that you're tackling the most expensive debt first, which is costing you the most in interest charges. Let's say you pay $300 per month on the card with 30% interest rate. After 10 months that debt will be eliminated. Then you'll take the $300 you were paying on the card with 30% interest rate, and apply it to the card with 25% interest rate. This way you'll be paying $600 per month and that card will be eliminated faster. Once that card is paid off, you would focus on the card with the 20% interest rate and so on. The advantage of the avalanche method is that it can save you money in the long run by reducing interest charges. But it might not be as motivating as the snowball method, as it takes longer to see progress. Up next, the strategy we have is consolidation and refinancing. Consolidation is the process of combining multiple loans into one, and refinancing is the process of replacing an existing loan with a new one with better terms. For consolidation, one of the most common forms is a balance transfer credit card, where you transfer multiple credit card balances into one card with a lower interest rate. This can simplify your monthly payments as well as lower the interest rate on your debt. For instance, if you have 3 credit cards with balance of $1,000 each and interest rate of 18%, 21% and 24% respectively, you can transfer all balances to a balance transfer credit card with 0% interest rate for a limited time, usually 6 to 12 months. This way you'll be paying only one monthly payment, and you won't pay any interest on that debt during the 0% interest rate period. Another form of consolidation is student loan consolidation, where you combine multiple student loans into one loan with a lower interest rate. This can also simplify your monthly payments, and also lower the interest rate on your student loan debt. For refinancing, one of the most common form is mortgage refinance, where you replace your current mortgage loan with a new one with better terms. This can lower your interest rate and your monthly payments, as well as shorten or extend the loan term. For instance, if you have a 30-year mortgage with an interest rate of 4.5%, if you refinance to a new 30-year mortgage with an interest rate of 3.5%, you'll be paying less in interest charges and your monthly payments will be lower. The advantage of consolidation and refinancing is that it can simplify your debt repayment, and it may also reduce your interest rate. However, it can also mean extending the loan period and paying more in interest over the life of the loan. It's important to consider your own personal financial situation, your credit score, and to shop around for the best interest rates before consolidating or refinancing your debt. It's important to know all the details and terms of the new loan, and to make sure it's the best option for you. Now that you have an idea of the different debt payoff strategies, here are a few tips and tricks to help you pay off your debt more quickly and efficiently. Create a budget. This will help you understand where your money is going and where you can cut back. By understanding your expenses and income, you can identify areas where you can reduce your spending and redirect that money towards paying off your debt. You can use apps and online tools to create a budget and track your expenses. Automate your payments. Setting up automatic payments ensures that you never miss a payment and helps you stay on track. By automating your payments, you'll ensure that the minimum payment is made on time, and you'll reduce the risk of late fees and interest charges. Look for ways to increase your income, whether it's getting a side job, asking for a raise or renting out a spare room. Any extra money you can bring in can be used to pay off debt. This can be a great way to accelerate your debt payoff and get out of debt faster. Prioritize high interest rate debt. Prioritize your high interest rate debt before the lower interest rate debt, as high interest rate debt is costing you more in interest charges. Stay motivated. It can be easy to get discouraged, but remember that every little bit you pay off helps and you're closer to becoming debt-free. Find a way to stay motivated. It could be setting small goals, rewarding yourself for reaching a milestone, or visualizing your debt-free future. Stay focused on your long-term goal and celebrate small wins along the way. So, there you have it, the top strategies for paying off debt. From the snowball method to the avalanche method, consolidation, and refinancing, you now have the tools and knowledge to tackle your debt head-on. But the real question is, which method will you choose to conquer your debt? Will you go for the quick wins of the snowball method or the long-term savings of the avalanche method? Maybe consolidation or refinancing is the right move for you. Whatever strategy you choose, remember to have a plan and stick to it. It's not going to be easy, but with dedication and perseverance, you can become debt-free. And don't forget to hit the subscribe button, and leave a comment below with your favorite strategy. Thanks for watching, and stay tuned for more videos on how to take control of your finances and reach your financial goals.